Hey everyone, welcome to SumZero. Today we have Adam Wyden from ADW Capital. Adam's started his business back in 2011. He's been managing a few $100 million. Incredible manager, knows his companies really well. Adam, would love to hear about your strategy. I know you're kind of a super concentrated value investor, but before we get into API Group, one of your investments, maybe you can just give us a quick overview of just how you think about the world, specifically investing, and we can take it from there.
Sure, Divya, thanks for having me on, and it's been great sort of getting to know you over the last several years. I guess I think we met originally even when I was back at Columbia, so time does go by quickly. What about the strategy? I mean, look, obviously, I think everyone starts sort of as a diehard value investor doing nets and finding companies trading below cash. And, obviously when I was at Columbia Business School, that coincided with, sort of the great financial crisis. And so finding companies that were trading at a discount to sort of liquidation value, there was so much distress and so many companies that, sort of their existence were in question, in many ways very similar to the COVID period, although that period was much more truncated. And so, I would say coming out of business school and sort of launching my own business, I think there were many what I would call, deep value sort of existential opportunities. And those were great. And, I participated in those personally and, and in the strategy to some degree, post school, it's like every other investor, as you get older, you want to limit the number of decisions that you're making. And so, I think over time, we've sort of gravitated more towards companies that have great reinvestment returns. Now, the idea is we want to find those, when those, are sort of, left for dead. I mean, that's a hard ask, right? You saw it with MasterCard and Durbin. You saw it, with our Ferrari investment post spinoff from Fiat, where you sort of find these companies, sort of in what we would call air pockets, where everyone thinks it's X and it's really Y. And so you get both the multiple expansion and the earnings growth. And that's really our focus now. We've spent some time early on doing activism, and we were reasonably successful at it. But I think that the challenge we found with it is that there was so much time and energy, sort of expelled trying to sort of convince management or the board or whatever the core governing body was that we were right, and sort of getting past the ego of some young kid coming them and telling them that what they're doing is wrong. And so, while we did have some success, I think it had, what I would call headwinds as it relates to our IRR. And so I think our strategy is sort of modulated to the point where we're really trying to find companies that are owner operated, sum of the parts, businesses where, we have the alignment of the board and management, but we sort of understand the source of mispricing and sort of the cadence of how that mispricing will evolve, which I think is probably a very nice lead up to sort of how we got involved in API Group and, sort of how that investment has evolved and why we think it's particularly interesting now.
Yeah, and just a little bit of backdrop for folks listening. So you're well known on SumZero for your Ferrari position, and I think you've talked about it quite extensively. And I remember, that you were very concentrated in that. When you originally put that position on years ago. I was looking at just the public filings on API Group, and at least on Yahoo, it shows you owning like 5 million shares of the business with like over $100 million in position size and this like one name. So from a concentration standpoint, without having like, to date specifics or exact numbers, like this would seem to be a huge position for you, extremely high conviction, and if it is, it would certainly be sort of an extreme example of your general philosophy around placing big bets on names that you really believe in. So first of all, am I correct in that assessment, just in terms of the relative value of the position in your overall portfolio?
Yeah, I mean, I don't know. I guess you're looking at dated filings. I mean, it's totally possible we could even own more than that, but I'll let you guys, let your imaginations wander on that. But it's definitely a nice chunky position. I would say that I think you have to think about concentration a few different ways. I think, having you could have a 100% position in the S&P and do well because the S&P, basically rebalances over, periods of time. I would say that, whether it be Ferrari or API Group, when you have a business that you've really sort of stress tested, which, obviously in the case of API Group, we've owned it through COVID, and then again through this sort of interest rate, what I would call taper tantrum, whatever you want to call it. The interest rate, FX, supply chain, inflation, all the things that sort of I would call the ripple effects of COVID. So, it's sort of we've sort of stress tested the business, and I think coming out of last year, we were particularly impressed with how the company managed. They did a large acquisition, and we'll get to it, but in greater detail. But long story short, we were really, really pleased with how the company sort of managed the sort of the last year with the FX and supply chain and Chubb, and as we sort of got access to new capital, we continued to add to the position, largely because we think that one of the values we have is, or the value adds we have is that when you know something, knowledge is compounding, and so the ability to follow a business for 4 years and sort of see how it behaves in different environments is actually to us is like a real competitive advantage. And so, for us to be able to acquire shares at prices on an EV to EBITDA basis lower than where we started the position, with a lot more scale and a bunch more business mix, it was almost sort of like, it would almost feel criminal for us not to, sort of advantage that information that we had, right? That to us is an asset that others don't have.
So let's get back to basics on what is the company, what do they do? And I guess, how did it initially your screen?
Yeah. So, obviously throughout the lifespan, we've sort of found industry verticals that we particularly like. We had a successful investment in a laundry equipment distribution company. So we sort of had some exposure to industrial services, what I would call, sort of business services, industrial services, these sort of, we had some successful investments in housing. So I think we were familiar with sort of the fire sprinkler, fire safety industry as sort of a vertical, that private equity had been involved in, and sort of saw it, sort of tertiarily in other businesses. But actually it came through a thought partner investor of ours that basically had been exposed to the business and pointed it out and had said, look, Martin Franklin from Jarden and his team have, basically, sought to basically recreate a sort of an industrial services platform similar to what they had built at Jarden. And, it was very clear to us that it was a non-marketed transaction. And, we basically, did our traditional scuttlebutt and research and figured out that, this was a company that, had deep culture and deep history. And I think that, that the founder of the company, or I guess the son of the founder, Lee Anderson, was very important. It was very important to him that the company was sort of left in the hands of someone that was going to build it, not, sort of break it up. And I think, without, with sparing you the nitty gritty, I think the idea is that, a traditional private equity firm would have, basically sold the crown jewel and taken all their equity out and sort of done a levered recap on the rest of the company. And that was sort of our takeaway from all the diligence we had done. And so we were very, I guess it was very easy for us to sort of ascertain why, Martin and company were able to acquire the company cheaply, because it was very important for the founder, who had been ill, to get cash. They had an ESOP, so it was very important that that the people that were basically buying the company were going to take care of the employees. And I think it was less about sort of trying to maximize every dollar, but really the stewardship. And I think the combination in any great investment, entry price is super important, right? Like you can buy Ferrari now, which is still a great business, at 30 times EBITDA. It's very different than when we acquired it at 6 or 5, whatever,
Yeah.
five or 6. So I think it's important to understand, sort of entry point. But yeah, we got, sort of referred to the business by one of our partners. We obviously it was very easy for us to get up to speed quickly on sort of Martin and his track record. And, we obviously were familiar with the industry, and, I think that the initial thesis was that they were going to build out the crown jewel as opposed to sell it. And I think broadly speaking, I think, if you look at our original underwriting and sort of what we thought was going to happen over the last 4 years, call it, I think we initiated the position originally in the fourth quarter of 2019. We're going on 4 years now. I think everything is sort of played out as we had expected. Obviously, the macro stuff has been a little bit different, but broadly speaking, I think the investment thesis has played out from a qualitative perspective.
Did you originally invest like post DSPAC, or was it before? Like, when did you get involved?
So it's not original. It's interesting. It's the way Martin Franklin does these things. It's a very, very different process. He raises the money, in a European-based entity holding company. There are no sort of, when they announce the deal, it's not like you have recycling. Like you invest the money. It's almost like a closed-end fund, Divya, like Ackman. You invest the money, you're stuck there. I mean, you can sell your shares, but like it's a closed-end fund. So there was no de-SPAC, there was no recycle. Everybody who owned the shares, if they wanted to sell, they could sell, but they could have sold at any point, right? Like the money was captive. There was no re-raise, right? There was no recycling like in a traditional SPAC. More importantly, I think it was $1 billion capital raise, and I think Franklin and sort of the underwriters, they put up $200 million. So you want to call it general partner profit participation. They put up 20%, and they don't actually get a share of the company upon consummation. They only get incentive fees or sort of performance equity based on share price appreciation. So you very much get a huge amount of alignment, right? You have a lot of capital, of the original capital going in being theirs, and then of course they only really get compensated if the shares do well. So that the timing was, they had announced the deal, I guess, in 2019. They closed in September of 19. And then this is part of the source of mispricing. The company was delisted from the London Stock Exchange and then was put on the pink sheets. And so we acquired shares actually on the pink sheets. And in the middle of COVID, it was still on the pink sheets. So it was like a weird, funky thing where, it was trading on the pink sheets in the middle of COVID with pretty thin liquidity and wasn't actually on the New York Stock Exchange when like traditional investment managers can even own it until May of 20. So there were a lot of sort of what I would call, and this is what we love. I mean, you call it spin-off investing, you call it technical dynamics, but we like these things where like you can own a great business, understand why other people can't own it, and then also obviously understand why they can own it. And like to us, it's really like, with Fiat, it was the same thing. It was like, okay, the only way you're getting Ferrari stock, you weren't even getting any in the IPO. They IPO'd a very small amount, is if you own Fiat. And then all the guys who owned Fiat were automotive investors. And they didn't know what they were looking at. They just puked it. And so, but it's, again, it was one of those situations where like you didn't really have like a natural research analyst base. They didn't know how to value it. And I think it's very similar, right? Like you had a business that had never really been public. There were no pure play fire safety and inspection businesses. There were smaller versions that were within public companies, like divisions. And then there were some sort of private equity backed roll-ups, but nothing of scale. And so,
why is it a great business?
Oh, that's simple. If I told you that you couldn't operate a building, like a commercial building, an apartment building, a warehouse, if I told you that people were not allowed on the premises without a working fire alarm, fire sprinkler, fire panel inspection every year, like you'd say this is an incredible business. It's a very, very small share of wallet. So you have an inspection and let's say it's, I don't know, $1,500 or whatever it is on a huge commercial facility. Like when they raise the price to $1,600, you don't really notice because it's a small share of wallet, and B, you don't really have a choice. I mean, so it's a highly skilled process. It's highly technical, you have, it's very oligopolistic in certain markets, right? It's very hard to build, scale because, the technicians want to work for the guys who have all the business, and the Walmarts of the world and the big companies, they want to do the business with the guy that has the lowest prices and the guy that, can basically, where they can stand behind the work. So it's I'm trying to think what the correct analog would be, but it's an industry where there's almost no cyclicality. you have an enormous pricing power, and it's, there's no, there's sort of no like sort of technological obsolescence. So, very rarely do you find these businesses that sort of have no technological obsolescence, don't have a risk of going away. There's a lot of small players. API now is the biggest player, which obviously advantages them in a number of ways as relates to procurement and supply chain. But again, the industry sort of grows, I'd say 5 or 6%. API can probably grow double digits as they, this is top line without, by winning market share. And then obviously it's got pricing power. So there's great opportunity for margin improvement. But, it's just a highly skilled, highly technical, recurring revenue, business. And, these are hard to find.
It's surprising to hear that on fire safety, like that it's highly technical. And it sounds like it was fragmented. They seem to be growing share, and I just wonder, like, what is preventing a disruptor from coming into that market? Like, how do they maintain that positioning in what sounds like not the most complex, market? Say, I could see how like Tesla, for example, might have like a multi-year advantage because of all of the battery tech that they have and the software tech and all. But with fire safety, it's a little less intuitive. So I'm just curious, what is the advantage from?
Well, the labor is unionized. Let's start with that, broadly speaking. So, I'd say that, the technicians want to go where they're getting the most volume, right? Because they want to stay busy. They don't want to be at the quote unquote lodge. So I think that the advantage is the technicians want to work for them because it's volumetric and it drives them. I think, when you have a large national footprint, when you acquire different businesses in different geographies, for example, if I go and I buy a fire safety, location, from a mom and pop guy, the first thing we do is we start working on the procurement. We start driving the cost down from the manufacturers. So we either keep that or deliver that to our customer, oftentimes both. And then we start, looking at it and then seeing in a market where, if it's Walmart or Facebook or whoever, trying to figure out how we can go and win that business in that market from somebody else. And oftentimes, the customer is happy to move it over to the other guy because, they want to consolidate their supply, sort of their, sort of vendor base. So, what I would say is that, the work itself is very technical, and it's a technical, you have to sort of have the, how to do the fire marshal, how to do this, how to do that. It is very much skilled labor, but I would say that, part of the moat around it is, the labor wants to work for the guy who's going to, deliver them the most business. And I think by and large, when you're consolidating the industry and you have the great brand name, people want to go work for you. I mean, similar to Goldman Sachs. I mean, anyone can go in and start an investment bank. People do it, but kids every year when they graduate college, they want to work at Goldman, right? Or they want to work at Blackstone. And so, I think we have the reputation of being the best and the biggest. And I think, if you're a mom and pop, there's sort of a limit to, how much you can do. Yes. And so what you're seeing now is you're seeing private equity firms try and buy these little mom and pops, and they're sort of building these platforms, but, they don't have I don't think, at least from what we can see, they don't have sort of the culture and the upsell, cross-sell motion that, this business has, where we've got, years and years and years of reputation with our customers, and then, having a national footprint. So, again, moats get built over many, many years, and this business has been around for, many, many years. In fact, the CEO has been running it since 2000, but I think the original business that Lee Anderson's father started in the early 20th century.
Incredible. What would you say is this a name that would screen, would fall into like a traditional value screen, or not so much? I'm just curious, like just from a pure financial standpoint.
Yeah. I get what you're saying. No, I mean, look, it's not what I would call like a sort of a value trap or sort of a value-y, like it's not like some automotive supply company that's going to trade at 4 or 5 times EBITDA. Like it's like you're not going to go look at this and be like, oh my goodness, this trades at 4 times EBITDA. This is a wildly asset light business with immense free cash flow conversion. So, what I would say is that, this business is, the last 4 years, we've changed the mix dramatically. So at the time of inception, it was about 50% fire. They bought Chubb last year from Carrier. Now I think on an EBITDA basis, it's probably like 80-20, but on an EBIT basis, it's probably like 90-10. And so the transition to 100% fire is largely behind us. In fact, you got the balance sheet of Chubb, but not all of the earnings power. So why it's particularly interesting to us now is that basically all of the restructuring and all of the sort of the front end work to integrate Chubb, which was a carve out from Carrier, that's sort of happening this year. And then as you roll into 24, there'll be no add backs. You'll get all the free cash flow conversion. And so, I think what I would say is, if, I don't think any security, that, is 9 times next year's EBITDA is going to be perceived as sort of a value stock, right? But the flip side of that is, MasterCard or Visa or these great companies. I mean, these things were cheap at 15 times EBITDA, 10 years ago. I think, if I look at private equity and I look at where these companies have traded, platforms have traded in the high 20s of EBITDA. So like 21, 22, 23 EBITDA. And, we think that we're creating this thing at about 9 and some change. And I think at least for the next few years, we think that this business can grow, earnings, 20+% as they're sort of leveraging margin, procurement, all the things that were headwinds over the last few years, start becoming tailwinds. So, for me, if I can find an asset light business, that trades at let's see, where does it trade today? Let's say it trades at, I don't know, a double-digit free cash flow yield that can grow free cash flow at 20+%, not including any tuck-in M&A. I think that's a pretty amazing return. And then when I look at Cintas and some of these other companies that are sort of similar, look at Rollins and, what are some of the pest control guys are trading at, I don't know, 1%, 2% free cash flow yield. Waste trades at, 3% free cash flow yield. So to me, if this thing were sort of trading at like a 5% free cash flow yield, the stock's a double. I could make arguments for why it should trade at a 2 or a 3. But I mean, I think for me, I look at this and say, if this thing trades at a 5% free cash flow yield, they grow free cash flow organically 20%. That's still a 25% total return with the stock being a double. So I think that's immensely cheap for sort of what I would call a quality, sort of a Buffett good company, quality company that you don't have to sell.
Yeah, I mean, and for you, I mean, you mentioned you own this for almost 4 years now. Could you see another 4 years? Like, do you have any kind of any exit time frame, or is it just sort of watch and see how it goes? And
I think it's valuation. I think it's valuation dependent. I mean, I think we try and put all of our investments through a framework of what is the total return prospectively. So, if it trades at $54 today, very different than if it trades $54 in 12 months or in 24 months. But, ideally when we sort of think we put our companies in sort of our framework, our matrix is what is the free cash flow yield today, if there is free cash flow, plus the growth of free cash flow. That will be our total return, assuming no multiple expansion, right? And we generally like to have that number look like over 20. So, so the answer is in this case, again, if you're going to grow free cash flow at 20, presumably you could own this at a 0. I mean, I'm being glib, but my point is that like practically speaking, we want to own things that can compound free cash flow at, or the free cash flow plus the growth of free cash flow has to exceed 20%. So the short answer is it'll really just depend on how quickly the market sort of values or again, we like to own undervalued securities and we like to sell overvalued securities. But I think it'll really depend on what is the quantum of the M&A and how quickly the thing sort of trades at a multiple because again, the multiple is really a byproduct of free cash flow, right? So if I look at it and I say to myself, okay, like right now this thing's $28, it's 9 times EBITDA, 10% free cash flow yield. If it's $54, or double $56, I'd say, okay, it's a 5% yield. Like, if it's still growing free cash flow at 20%, we might very well own all of it, right? It just depends on what's going on in the rest of the portfolio and whatnot. But I mean, I think, the short answer to your question is we could see ourselves owning this for a very long time.
So one of the earlier things you mentioned, I thought was really very interesting, was sort of speaks to the sort of recession-resistant nature of the business. Have you sort of tested that? I mean, obviously, fire safety is a building code requirement for pretty much all buildings, but how does that really play out? And because a lot of people are still talking about recession in the back half of 2023, recession 24. I'm just curious how you think it impact either the multiple itself or the fundamental business.
Yeah, I mean, look, I think there's a lot of tailwinds from a multiple perspective. I think, because the industries they serve, I mean, first of all, even if you're not growing commercial real estate, let's say you're not growing Class A office, the guys who still have it, in order for it to be open and rented, you need to have all the equipment work. And if the stuff breaks, you still have to replace it, even to have one person sitting in it. So, I don't really worry about that. And again, such a small percentage of the business is what I would call new installation or new construction. I mean, building stock in America only increases by 3 or 4% a year anyways, in aggregate, right? And so, I would sort of be careful to say, hey, this is sort of economically sensitive. I mean, if you think about how these fire sprinkler businesses have worked, and we've done our work in 2008 and 9, I mean, these things were down, these things were not even down EBITDA. What had happened is, sort of new construction slowed a little bit, but a lot of the maintenance and repair stuff sort of was higher, and sort of people deferred and they repaired, and it was higher margin. So in general, these assets sort of were EBITDA up in 08, 09, and that was a really bad recession. I'm not really worried about having something like that. I also think with the Inflation Reduction Act and the CHIPS Act, you have a lot of semiconductor, fabrication, you have a lot of infrastructure spending. So there's a lot of stuff going in there that, is sort of going to, offset, and all that stuff will need fire suppression panels, this, that, and the other. But I think in general, like, this isn't a business that is particularly levered to like new construction or the economic cycle. In fact, I'd actually even say that's an advantage right now, because what had happened is, in a lot of times, you sign these multi-year service contracts, and it's cost plus, and then you price the cost increases, but not with margin. Those sort of reset a third. They're usually 3-year contracts. So every year you basically a third should roll off. So what's happening now is, as inflation goes down, you're repricing a lot of your old service agreements with the margin. And so I think you have a lot of sort of what I would call revenue and margin tailwinds in the business. And I if anything, there's probably going to be, and I think they said on the conference calls, we're actually being pretty careful about turning away business that doesn't sort of fit our margin profile. So I'm not particularly worried about a recession for a variety of reasons. The stuff that secularly is going on with the CHIPS Act and the IRA, and, healthcare and semiconductors. And just intuitively, like, even if that wasn't going on, if I look at like how these businesses performed in 08, 09, these things are pretty bulletproof. Which is why it deserves a higher multiple, right? It's why it shouldn't trade at 9 times EBITDA.
Yeah. Tell me about the cap table. Anything notable there? I know there's a couple names in the mix, including Viking and Lua. I actually know I have a friend over there who maybe I'll ask him about the name as well. But anything notable about kind of the owners, at least the larger equity owners in the business?
Yeah, I mean, look, obviously, I think Viking was part of the original sort of sponsor group. So they were the anchor investor. They've obviously not sold any stock. They participated in the preferred offering to buy Chubb. So those guys are super, super long-term. I believe they own it through their private equity vehicle. So, that's super exciting. And, we've obviously had the opportunity to interface with most of the people on the cap table. I would say that, without sounding too pedantic or arrogant, I think we are the pioneers. We've sort of been sitting, most of us have sort of been sitting in this thing for a few years, sort of waiting for this thing to blossom. And part of value investing is recognizing that, you can have situations like Ferrari where, people very quickly figure out the quality of the business, and it goes from trading at 5 times or 6 times to, 30 times. And then sometimes you have sort of exogenous events like we had with COVID and sort of the supply chain and the inflation. But, I would say that, everyone that sort of owns it, I think, is sort of bought into sort of the thesis and sort of is, very happy with how it's all played out. I think if you look at the cap table, it's very, very thin as it relates to long onlys, and the people that you would expect at the top, the Putnams and the Fidelities and the Capris. I mean, those guys are sort of missing. So, what I would say is that, it's very much an orphan stock. And I mean, this is what we do, right? We buy these companies, we partner with management, we sort of are the patient capital. We are the bridge capital for the sort of the people that sort of buy it when it's on the rails. And I think what's particularly interesting about API now is we think it's sort of going on the rails, meaning like all of the restructuring from Chubb is behind us. Cash flow conversion is going to explode. Margins are going to go up as they reprice all the old service contract and some of the, the inflation lag. And people are going to see the earnings power, both the free cash flow conversion and the return on invested capital. And I think it's been muddied because, the company is sort of, they in 2021, they were worried about supply chain. So they bought a ton of working capital to basically have products for 22. So their free cash flow conversion was weaker because they were buying stuff because of the supply chain in Asia. So a lot of the issues that the 21 and 22, I think that they were sort of ephemeral and probably one time in nature. And I think people sort of penalize them, wrongfully. And I think a lot of that, a lot of what's going to happen this year and into next year is sort of the unwind, people saying, okay, here's what the margins are. Here's what the cash flow conversion is. Here's what the CapEx is, right? I mean, if I told you that CapEx was X, I'll give you an example. Like one thing that we think is super silly is the company reports gross CapEx, but they sell $25 million a year of equipment, because they buy vehicles and stuff for people. And, we think that they should do a net CapEx, report net CapEx, net of trucks and asset divestitures. That's 65 million. I mean, but you do the math. If you have the same amount of CapEx on 600 of EBITDA versus $1 billion of EBITDA, you're going to have a different view about the free cash flow conversion and the EBITDA and the capital intensity. And so, we sort of look at this and we say to ourselves, a lot of the heavy lifting, a lot of the messy stuff, sort of took place in 21 and 22, 23, we're sort of, I'd say 75% out of the woods. And then, going into 24, it'll all be behind you. You'll basically be getting all of the tailwinds. And so, I think it's just, people are lazy, people are lazy, prove it. And that's the opportunity. That's why, if you look at sort of our filings,
that the bigger guys, you're confident the bigger guys like Fidelity are watching the name. They're just waiting for the story to clean up a bit.
Yeah, I mean, look, obviously you can look at the cap table. I think, there are some large guys in there, but I think if I were to look at like, an Ecolab or a Fastenal or like a Cintas, I mean, like, if I pulled up like Cintas, for example, that's a $45 billion company, I think. So, I look at that cap, it's 54 billion EV, 50 billion. It does 2.2 of EBITDA. Okay, so we're gonna, I think API will do $1 billion next year. We should be so lucky that that we get there. I mean, that trades at 25 times EBITDA. But when I look at it, Vanguard, BlackRock, State Street, Geo, FMR, T. Rowe, Columbia Management, Franklin Resources, Brown Advisory, Northern Trust, Norges Bank, BNY, Select Equity, 300 million, Pictet, 300 million. I mean, Luther King, 250. I mean, those are the types of players that, what we would call the quality long only guys that, that are investing in American Century, Nordea, Invesco, Capri, William Blair, PNC, Wellington. These guys are the guys that, sort of occupy the cap tables of these never sell securities. And, to us, this, this sort of fits in that bucket, where it's a super high quality, recession-proof business with great free cash flow conversion that's sort of, been built, brick, hammer and nail over the last 4 years. And, I was watching, I know this is totally a little bit of a sidetrack, but I was watching the Steph Curry documentary on Apple TV the other day, and they were like looking at this guy, and the guy had no business being, in the league. But, look, they basically, he had the makings of, a Hall of Fame basketball player. And, over 4 or 5 years, he went from, barely getting recruited to, basically being, the best and one of the best NBA basketball players of all time. And I think, I look at API Group and it's like, it's a business that had all the makings of what I would call an a business services asset light industrial powerhouse, but just didn't have sort of the training and they had the operational leadership, perhaps not the capital allocation leadership, but the partnership with Martin and co to sort of purge some of the lower margin business, build out the higher margin business, and sort of get this thing to a point where it looks a lot like more like an Ecolab or a Cintas. I mean, I don't think it's that very different. I mean, to me, this is a company that is that has been underrated and underappreciated for far too long. And I think this is sort of like Steph Curry, about to get drafted by the Golden State Warriors, because we've invested 4 years.
Yeah. What's the risk? What's the risk that it gets taken out? What's the risk that it gets taken out by a strategic before it's able to sort of like reach that maturity that you're, or that aspiration that you think it deserves?
Well, I mean, what strategic buys it? I mean, obviously you have the benefit of having super patient capital and people that are obviously very aligned with you. I don't know, like in this day and age, are there that many sort of hostile bids at with a 9 billion EV or 6.5 billion EV? Not really. So, I obviously, if someone showed up and said, "Hey, we'll pay you $65 for it tomorrow," obviously these guys are thoughtful that they'd entertain it. But that's always a risk with any scenario. I think it is highly unlikely, that the company would sort of, give themselves away at any multiple lower than high teens, 18, 19, 20 times EBITDA, only because that's what the business is worth. The business, if Pi Barker, which was doing I don't know 130 of EBITDA, sold for 23 times, right? Like, why am I going to give away my company for less than 18 or 20 times? I mean, yeah, okay, you ascribe a little bit of a premium to the fact that the multiple can get bought down through M&A. Sure, you can buy 130 million of EBITDA and buy the multiple down a little bit. But at the same time, like, it's also like you're buying a less geographically diverse, smaller business. So to us, this platform is very valuable. And, this is the type of thing Buffett would want to own. This is the type of thing, any great sort of, sovereign wealth fund, Buffett, anyone would love to own this thing, because this is something that you have great management, you have great culture. This is just something you own forever. So, I mean, obviously with any business, there's a risk that, that a strategic tries and buys it. I just think, you have people that have invested their own money in this that are capable operators and know how to run it. So, the opportunity cost of, having the capital somewhere else would sort of be the gating issue. I don't think there's any other reason why, that this, so I don't really worry about that. Those are first world problems. Those are 150% higher than where we are right now.
Just on catalysts, anything in the next 6 months that beyond earnings, but anything people should be looking out for in the next, through the end of the year?
Yeah, I mean, look, obviously, they generate most of their free cash flow in the back half of the year, so you're going into the strong season. The company has been very, very conservative with their guidance. They've been beating the first couple quarters, or at least the first quarter. I don't think they raised their guidance by the size of the beat. You can look to First Service. First Service has a small fire safety division that we basically track that's pretty close, that in terms of organic sales. Also, Cintas has a small division that's pretty close. So those companies are sort of reported through May. The companies pre-announced their June revenue numbers, so you're not really worried about that. So, it's really going to come down to margin and free cash flow conversion. But again, the company sort of cited a leverage target that they've basically, gotten to where they want to be. So I think they'll probably be more aggressive on capital allocation. So that's either tuck-in M&A or buyback. I think that's sort of been part of the story that's been missing. So obviously, anything on the buyback or tuck-in M&A front is probably incrementally positive because the street doesn't model it. Obviously, to me, we like series of soft catalysts as opposed to a hard catalyst. So they're going to keep beating earnings likely. They're going to keep generating cash and allocating it intelligently. And, I think that there is natural pessimism around the asset, which is good because no one trusts the free cash flow conversion, even though the company's called out how much of it. I mean, again, when they bought Chubb, this is a business that was orphaned inside of an HVAC services business. So you had an HVAC manufacturer, right? And you had a fire safety and inspection route-based business in Europe that was a total orphan, right? So the work that we had to do in terms of exiting sort of unprofitable business, exiting, doing site and route consolidation, standing up the technological infrastructure. There was a lot of heavy lifting that was associated with basically carving out a division of a public company that I think was sort of, there was a cash, cost associated with it. Maybe it's a couple $100 million, but I mean, that was basically rolling through the P&L for 2 years, which is all going to be basically gone in 2024. So I just think things just get a lot cleaner. I mean, they're still generating a ton of cash, but like, to us, it's sort of like, I use this line. It's been an excuse, not a reason. There are no more excuses. Like when people look at this company next year, there are going to be no more excuses. You'll see it in third and fourth quarter of this year.
Yeah, I mean, just kind of. Well, if there was one thing that you'd say the markets most misunderstand about the situation, what would it be?
I think it's just business quality, right? It's the people think that it's sort of an infrastructure construction company, and I think they comp it to like a power, like a PWR, like a Quanta, or like an MCore. And I think the market sort of, it's like Ferrari. It's like everyone thought Ferrari was an automotive company. I think people think this is a lower margin construction company. And I think that, all the stuff that's gone on the restructuring front has basically made people think that it's a low cash flow conversion business. But it's very different than spending the money on CapEx and working capital than it is sort of one-time costs associated with right-sizing an acquisition. I mean, remember, Chubb is basically the same size as API. I mean, they bought a business that like pro forma will be like the exact same size of sort of pre-Chubb API. So you can imagine the amount of money that went into that, right? And so, I would say that people just think it's lower quality than it is. And it's I know that's like sort of soft, but I think that's something that gets borne out over time. And I think you're starting to see the sort of the makings of that this year. I think you will continue to do that. And then I think next year, people will be looking at this and they'll, the people at those big long onlys will be like, oh, wait, like, here's what net income is, you don't have any restructuring going through it. Your cash flow is converting at X%. Your CapEx is X. I mean, it's all iterative. I mean, I think it's like, it's like when you think about Facebook or MasterCard or Visa, it's like, people, they look, it's guilty until proven innocent. And every single time you sort of deliver on the margin, deliver on the cash flow, people sort of wake up. And sometimes it happens very quickly. Sometimes it happens, more slowly. I mean, in Ferrari, I saw it happen very quickly. And this time it happened very slowly. But, for all we know, we could be $75 at the end of next year and everybody figures it out really quickly. I mean, it's what is it? Thinking fast and thinking slow. I mean, sometimes people think really fast and they just sort of jump to the conclusion quickly and they get it. Sometimes it sort of happens sort of very methodically and linearly. So, I've never really been great on sort of getting the timing perfectly. Sometimes we get lucky, but I think, what's interesting to us now is that, there are no more excuses to be made. And so, we're optimistic that, that this thing is going to re-rate pretty quickly now.
Adam, this is super interesting to hear. And I think the most interesting thing is kind of the way you talk about the business, with sort of your use of we as a pronoun choice, and just sort of thinking like a real owner of the business and not just like a stockholder or shareholder. So, with that, thanks for spending the time. I'll certainly be tracking the business. And, maybe one of these days we can get you and the CEO on the phone as well and in front of an audience. That'd be fun.
Yeah, well, we can talk about that for sure.
Awesome. Thanks, Adam. We'll be in touch.